Welcome back to Tesla Daily News Podcast. Today is April 1st, 2026. In the next few minutes, we'll break down the biggest Tesla headlines that could move the stock, delivery expectations heading into tomorrow's report, geopolitics that put Tesla on a target list, a notable legal development tied to Musk's Delaware disputes, what the broader Magnificent Seven drawdown says about valuation, and a quick look at how Tesla is staffing up in Berlin. Story 1. All eyes are on tomorrow's Tesla delivery print, and the stock is already reacting. Tesla shares have been choppy into the end of the quarter, and multiple outlets are pointing to a market that's basically waiting for the April 2nd first quarter delivery number as the next big catalyst. Here's the context investors care about. After a couple of years where Tesla deliveries often set the tone for near-term revenue and margin expectations, the market has become more sensitive to any signal that demand is either slowing or stabilizing, especially with interest rates, incentives, and competition all in flux. The details. One report cited a forecast of roughly 368,478 deliveries for the quarter, which would be slightly above some broader consensus estimates mentioned in that same piece. But it also highlighted how that would still sit well below a prior peak quarter of roughly 497,000 deliveries, implying a sizable gap versus the strongest demand environment. Impact for Tesla. If deliveries land above expectations, you could see a relief rally, especially given how negative sentiment has been around megacap growth this year. If deliveries miss, the stock reaction can be swift because investors will immediately translate that into revenue and, more importantly, gross margin assumptions, particularly if Tesla has had to lean on pricing or incentives. Takeaway. Tomorrow's number matters less as a single data point and more as a direction of travel indicator. Watch not only the headline deliveries, but also any clues about mix, especially how Model 3 and Model Y volumes compare with higher-priced products. Story 2. Iran's Revolutionary Guards put Tesla on a list of companies it claims could be targeted in the region. The hook. Tesla is explicitly named among a group of large American multinationals that Iran's IRGC said are legitimate targets, with language warning of potential action starting April 1st in the evening Tehran time. Context. This is happening amid a broader Middle East conflict and extreme sensitivity in energy markets. Equity investors are trying to decide whether de-escalation is real or just another head fake because oil, inflation, and rate expectations are all swinging with every headline. Details. Multiple reports list the same set of companies, including Tesla, Apple, Microsoft, Google, Nvidia, Boeing, and others. The statement also included warnings to employees to leave workplaces and referenced retaliation tied to events in Iran. Impact for Tesla. To be clear, this does not automatically mean Tesla has direct operational exposure in the region comparable to cloud providers or defense-linked firms. But markets don't need perfect exposure to reprice risk. Being named in a high-profile threat can add headline volatility to the stock and reinforce the current risk-off, geopolitical premium that's already weighing on growth names. Takeaway. For investors, this is mostly a sentiment and volatility story unless there is a confirmed operational disruption tied to Tesla facilities, logistics, personnel, or suppliers. Still, it's another reminder that geopolitics is bleeding into equity valuation through oil prices, inflation expectations, and risk appetite. Story 3. Markets bounced on hopes of war de-escalation, and Tesla moved with the everything rally. The hook. Futures and pre-market trading showed Tesla up around 1% in a broader rebound as traders reacted to reporting that the U.S. president may be willing to end the military campaign even if the Strait of Hormuz remains largely closed. Context. The Strait of Hormuz is a key global energy choke point. When energy prices spike, inflation expectations rise, bond yields can jump, and high multiple growth stocks often get punished because their future earnings are discounted at a higher rate. Details. Reports noted U.S. gasoline prices rising above $4 per gallon, oil trading around or above $100 a barrel, and bond yields easing from recent highs as the market tried to price a less escalatory path. Impact for Tesla. Tesla can trade two ways in this setup. On one hand, higher oil and gasoline prices can improve the consumer value proposition of EVs. On the other hand, if high energy prices push inflation and rates higher, it can hurt affordability for car buyers and compress equity multiples, especially for growth stocks like Tesla. Takeaway. Keep an eye on oil and yields together. If crude stays elevated and yields rise, that combination has historically been a headwind for Tesla's valuation multiple, even if the EV narrative benefits from higher fuel costs. Story 4. The Magnificent Seven drawdown is real, and Tesla is part of the broader rotation. The hook. One market recap estimates the so-called Magnificent Seven have lost roughly $3.28 trillion in market cap year to date, with Tesla down more than 18% in the period cited. Context: Tesla doesn't trade in isolation. In 2026, investors have been rotating out of high-growth mega-cap leaders amid uncertainty around AI spending, geopolitics, and the rate path. Details: the same report framed the Nasdaq as down around 10% year-to-date and described how higher-for-longer rate concerns reduce the appeal of future earnings. Impact for Tesla: when broad tech and mega-cap sentiment turns, Tesla can get pulled down regardless of company-specific fundamentals. The flip side is also true. If the market finds its footing, Tesla can benefit from factor flows back into growth. Takeaway: deliveries tomorrow are the company-specific catalyst, but positioning and macro are still the backdrop. If the tape is risk-on, a decent delivery number can travel farther. Story 5. A Delaware judge reassignment puts Musk-related corporate litigation back in focus. The hook: 3 Delaware matters involving Elon Musk are being reassigned to other judges after a controversy linked to a LinkedIn like that raised questions about impartiality. Context: governance and legal uncertainty have mattered more for Tesla since the long-running debate over Musk's compensation plan and Delaware's role in corporate law. Tesla moved its headquarters to Texas, but Delaware litigation still influences perception around corporate governance risk. Details: reports summarize 3 areas: disputes involving attorney fees tied to a shareholder case about director compensation, a case involving access to internal documents tied to Musk's 2018 going private tweets, and continued attention around the massive compensation plan that has been litigated repeatedly. Impact for Tesla: legal headlines rarely change Tesla's near-term deliveries or margins, but they can affect valuation through governance risk premiums and investor confidence, especially for institutions that are sensitive to board independence and predictability. Takeaway: the key investor lens here is not drama, it's uncertainty. Any step that clarifies process and timing can reduce overhang, even if the underlying issues persist. Story 6. Tesla's Berlin area factory is running an open day to recruit talent. The hook: Tesla opened parts of its facility experience to prospective apprentices and students in Grünheide, Germany, in a bid to recruit for multiple training tracks. Context: investors typically focus on production capacity and utilization at gigafactories. Staffing, training pipelines, and retention matter because they influence ramp efficiency, quality, and costs, especially in a tight labor market and amid ongoing scrutiny over labor relations. Details: the report says Tesla employs around 10,000 people in Brandenburg, including roughly 190 apprentices and 100 students, and is recruiting across 18 apprenticeship roles and 5 dual study programs. It also notes more than 1,000 robots in use on site, emphasizing maintenance and programming needs. Impact for Tesla: this is not an overnight stock mover, but it's relevant to execution. Better staffing and training supports stable output, lowers downtime risk, and can improve operational efficiency over time. Takeaway: Berlin remains a strategically important footprint for Tesla's European supply. Any improvement in operational maturity there supports margin resilience, especially as competition in Europe intensifies. Alright, let's wrap it up. Today's big themes were: deliveries are the next hard catalyst, geopolitics is adding headline volatility with Tesla named in regional threats, macro variables like oil and yields are swinging the valuation multiple, and legal and staffing stories shape the longer-term execution narrative. For tomorrow, the number to watch is Tesla's first quarter deliveries on April 2nd, and then how the market interprets demand, mix, and forward momentum. If you found this helpful, subscribe to Tesla Daily News Podcast and come back tomorrow for the delivery breakdown and the market reaction.